Hi and welcome to the Stefan Livera podcast, a show about Bitcoin and Austrian economics. Today, for episode 145, I've got an interview with Rahim Taghizadegan about his book, The Zero Interest Rate Trap. But first, a word for the sponsors. This podcast is brought to you by Kraken, one of the world's leading Bitcoin exchanges. They are one of the longest standing Bitcoin exchanges in the space. They're consistently rated the best. They offer a high quality platform with some of the best liquidity available in the industry. They have high trading volume and low fees with no minimum or hidden fees. Kraken have 24/7 support. The sign-up process is really quick. They also offer Kraken Pro mobile app, delivering all the security and features you love about the Kraken exchange in a beautiful mobile-first design for advanced Bitcoin trading on the go. Kraken also offer OTC desk for those seeking a more private and personalized service for large block trades. They offer margin and futures. They also offer the Crypto Watch platform, a popular charting and trading terminal for Bitcoin markets. So go and sign up at kraken.com. This episode is also brought to you by Unchained Capital, a Bitcoin financial services company empowering their customers with financial freedom and control. All their products and services are built on the foundation of multi-sig, so you retain control over your private keys while also receiving the benefit of a financial partner. So Unchained offer 2 of 3 vaults. You can use Trezor and Ledger, and these are a great option if you're thinking through how best to secure your Bitcoin for the long term. And if you need to access liquidity without selling your Bitcoin, Unchained offer collateralized loans, so you can get US dollars without selling. So that Bitcoin is stored on-chain in dedicated multi-sig addresses. It's never rehypothecated, and you can share in the security by holding 1 of 3 keys. I'm really impressed with Unchained. Look out for an interview I've got coming soon with Will Cole. They offer excellent services, and make sure you check them out at unchained-capital.com. Next, check out givebitcoin.io. Under the overarching brand of Swan, the easiest and safest way to get your friends and family into Bitcoin with just an email address. Take it from me. I've given Bitcoin to people before and they lost it. Give Bitcoin has a nice twist on that because your gift is time delayed with a regulated US custodian for 1 year. And during that time, Give Bitcoin is delivering 12 monthly lessons to your recipient. There's input from many well-known Bitcoiners. I'm also an advisor with a small equity stake, and I'm assisting with the curriculum also. And keep an eye out for more exciting announcements coming. There's a new brand and product coming called Save Bitcoin. So the aim is to really have a positive impact on Bitcoin adoption and understanding. So I'm excited to have them as a sponsor. Go and check them out at givebitcoin.io. Have you backed up your Bitcoin seed? You need to look into the Cipher Wheel product produced by CipherSafe, and the website is ciphersafe.io. So if you've invested in a Bitcoin hardware wallet, are you keeping that BIP39 seed backed up in a way that's fireproof, waterproof, rustproof, petproof, and tamper evident? Look into Cipher Wheel. It comes in a wheel shape. It masks the words of your seed unless you open the padlock tamper evident seal, so you know it's been opened. CipherSafe are changing up the stainless steel alloy used, so the product provides more corrosion resistance, and otherwise it scored an A on heat and crushing on a recent round of physical seed testing. Make sure that you or your loved ones have access to your Bitcoins if an accident occurs. The orders are going out in early February, so go and order yours at ciphersafe.io. So today, for the interview with Rahim, he is an Austrian economist from Austria, and so we talk about that in the interview. And Rahim joins me to talk about the problems with central banking and the social consequences of fiat money. So if you've enjoyed some of my earlier episodes on Austrian economics, or perhaps episode 51 with Guido Hulsmann, I think you will really enjoy this interview. We talk about some of the problems with central banking, what governments are unable to do under this environment, what impacts that has on the capital structure of the economy, and importantly, what are some of the social consequences of fiat money. So here is the interview. Welcome to the show, Rahim.
Thanks for having me.
So Rahim, I had the chance to read your book, and I was looking into a bit of your background. I think you've got a very interesting background. On your profile, you list yourself as the last Austrian economist. Can you tell us a little bit about that?
Well, yeah, the reason is more unfortunate is that the Austrian school disappeared in Austria, and the last members of the Austrian school, most of them moved to the United States, some elsewhere, but it was only in the US that the tradition has formed again from people really claiming to be members of the Austrian school. And I got to go to the United States quite a long time ago already as a nuclear physicist at the time. And I was studying economics on the side in Austria, and I never had heard about Austrian economics. So It grabbed my attention in the United States. I somewhere read or heard people talk about Austrian economics. And at first I thought it was the economics of Austria, but then I realized it's a whole tradition that really had disappeared in academia in Austria. So then I had a chance to learn from the last representatives of that school. And interestingly, they were German speaking, like Hans-Hermann Hoppe became one of my teachers. And there was another student of Hayek who remained in Germany, was Roland Bader, but he didn't teach at university. He was an entrepreneur and independent scholar, but he got to be my second teacher. And so then I immersed myself in this tradition and I tried to bring it back to Austria. And since then, I've been teaching Austrian economics at university as well in Austria, and I'm the last one doing that. So that's why I consider myself the last Austrian economist in a direct tradition.
Certainly an interesting story. And Rahim, tell us a little bit about Scholarium and the Institute. What's that about?
Yeah, about 12 years ago, I founded an institute with a colleague of mine. And what made us found an institute was that we were a bit frustrated at the university. I mean, it's not much better than elsewhere. Mainstream academia, in particular in the social sciences. And back at the time, there seemed to be an economic crisis looming, and some Austrian economists really had good timing back then, and I was fortunately among them. So there was quite an impetus to start as a research and educational institute, entirely privately funded by people who saw some real value in it and got some real value out of it during the last economic correction. Because business cycle theory turned out to be quite useful to understand the dynamics and even to try to apply it for investment decisions. So that was the impetus for the Institute. It has broadened quite a bit over the time. We now have a full-time study program, and we try to bring back the Austrian school as it was meant to be, as an interdisciplinary research program. We try to be aloof of ideology, so it's really about a deep interest in how the world works and how human beings work. And we combined it with the other traditions that arose out of Austria at the time, in psychology, in political philosophy, and so on, history as well. So that's what we try to do, and I think Vienna is a really good place to do that.
We have this book, The Zero Interest Rate Trap. Do you want to set the scene for us a little bit around why you wrote this book?
Yes, of course, because there's a lot of talk about monetary policy at the moment in Europe, but as well in the United States. And we've seen the Fed taking the lead before in lowering interest rates and going for quantitative easing and so on after the last economic correction. And the ECB has more or less followed suit. But in Europe, it seems to be more dramatic because more or less the euro, the whole currency, and the whole project of the European Union now depends so much on this kind of monetary policy. And if there's failure of this project, it'll have a lot of political implications. So there's some political turmoil already in the European Union, quite a few member states going their own way. We have this huge conflict about mass migration coming to the continent. So it's a lot more politicized, maybe, and a lot more crises in different areas seem to be affected here by monetary policy. It's not too different from the United States, where you also have this kind of polarization and in the political debate, but there's a larger diversity in Europe, so more aspects are affected. And that moved us into not only understanding this kind of monetary policy, but also its societal and political implications. And that hasn't been analyzed so far.
Right.
This deeply, and that's what we've tried to do with this book.
So for some of my listeners, not all of them were into Austrian economics before getting into Bitcoin. Some of them came into Bitcoin and now they're learning a bit of Austrian economics, right? And so for some of those listeners, I would typically recommend that they would read a book like What Has Government Done to Our Money by Murray Rothbard, and that they should read The Ethics of Money Production by Guido Hülsmann. And I think those books together will help give some insight into like why we ended up in this problem today. And also I think The Ethics of Money Production by Guido Hülsmann also touches on some of these cultural and spiritual impacts of inflation on society. And I view your book, it's kind of also touching onto some of those points and expanding on in a further direction. But for somebody who may not be as familiar with the Austrian story around, okay, why is central banking a problem? Can you spell out some of the reasons why an Austrian economist is skeptical of central banking?
Yes, because we see money as a social device which should help interaction, foster peaceful interaction. And so we're wary of any kind of intervention in prices, and the interest rate is a price as well, and in particular money. And there's very few historical laws, but there seems to be one that there's almost without exception. I think there are only two exceptions in history. The monetary base has been debased by those in control, because it's very tempting. It's like a hidden tax. So it has been done all around the world in almost every epoch. And one of the main outcomes of this intervention has been the easiness to finance wars. So there's been a lot of destruction to this kind of intervention in money, in this kind of hidden tax and transfer to the plunderers of society, and basically unproductive or even destructive ventures. So there's a quite of a historical backstory there. But we are now reaching a new terrain, and this turns out to be quite interesting in many senses. I mean, most economists, particularly from the mainstream, would have thought it impossible to reach that kind of state of monetary policy that we're in right now. And I think the deep understanding of monetary theory by Austrian economists, in particular Ludwig von Mises and of course Karl Menger before him, helped a lot more in understanding what's going on and really analyzing it, because not much has changed in the ideology surrounding monetary topics. We are right back at the same discussion that we had in the 19th century between Karl Menger and the representatives of the historical school. And those representatives were mainly following Mr. Knapp, Professor Knapp, who claimed that money is always a creation of the state. It's just a legal entity, so it's just by fiat. It's a convention set by the state, and that's everything you need to know about it. So, and Menger, of course, had the other approach of looking how certain goods are discovered by people in directions to have a higher liquidity, higher marketability. So he's looking at really the dynamics of exchange and interaction, and the spontaneous discovery of market participants. And it's not really a story about the history of money. It's a story about the function and the ontology maybe of money. And it's really important to have that point of view as well. Doesn't say that Knapp was wrong in everything, but of course it's a negation of this kind of really understanding empathically what people try to do with money, what are the potential uses, functions, and problems with money. You don't get all that part of the story, and it's basically the people side of money, and you only get the conventional side, and that leads to political hubris, I call it. And then we can see in particular the ECB policy and the EU policy is a kind of technocratic elite trying to steer things. They can really understand, and they can really control in the end.
Right, yeah. And so it's like you've got the chartalist state theory of money, and then on the other hand, you have the Austrians who are saying, no, it's actually spontaneous. It's a bottom-up thing. It's not like we explicitly agreed, this is the most saleable, this is the most liquid. It's just over time, it just emerged, right? And so we see that, and we contrast the Austrian understanding around money and economics, and then you look at what, say, a Keynesian might be thinking, and up until recently, and historically speaking, they would have referred to it as the zero lower bound, right? So what are they referring to when they talk about the zero lower bound, and why are we now actually going past that?
Well, to Keynes, the interest rate was a kind of liquidity premium, so he really wouldn't have thought about zero interest rate neither. And of course, it's a bound, but it seems to be a psychological bound right now. It's that we've had a real negative interest rates for quite a while. That just means the depreciation of money and purchasing power that people don't realize. And what the central banks are reluctant to do is to go to nominal negative interest rates. And I think it's quite likely there'll be a psychological barrier. Even for people who have no idea about money, that's what they understand is nominal values. And if they see the nominal value of the savings decreasing, they might panic, they might withdraw money from their banks, they might go into cash or other assets, of course. And of course, that's been going on for a while, but it may have this self-increasing tendency, which then leads to a flight out of money. And that'll be really bad for the exchange rate of the currency, which goes first for nominal negative interest rates. And it'll be good for wealth assets again. That's I think what central banks are afraid of. They get another kind of dynamic which is self-increasing by itself and can't be controlled anymore.
Yeah. And interestingly, I note in the book, and you talk about central banking and the impact that they have on society. And you point out there's actually a study by, is it Elijah Brewer and Julapa Jagtiani, showing that commercial banks actually tried to invest money to reach the status of being systemically relevant, which is like a very, in their view, that's rational, but from the system point of view, that's very irrational. Can you outline a little bit around what is that? What's that meaning of the systemically relevant, and why are they trying to play that game?
Yeah, because more or less the central bank monetary policy has been, we just produce the fiat money to buy off any assets, and they'll become the last bad bank of the system, buying up all the toxic assets, as they call it, in order to stabilize the system. But of course, they create incentives to more and more reckless behavior. And the focus of big institutions like banks and big corporations and so on, not to do productive work, innovative work, but somehow trick the system. And everyone, in a way, has to trick the system. I mean, that's how you make money by investing, is you try to trick the system, you try to anticipate what central banks will be doing. Thus, you render it futile what they're doing, and then so it's like anticipating a second order thing where this increased liquidity will go in which assets, and you can make a lot of money by being good at anticipating it. But that means that more and more money has less of a productive function. It's quite kind of a way to just like try to game the system.
I think maybe tying back to some of that point around the zero lower bound and so on. So obviously from an Austrian perspective, we're skeptical of some of these ideas, but someone who's coming from, say, a Keynesian point of view, they might think, oh, well, see, there's this output gap and we need to lower the interest rate to try and kind of juice the economy or stimulate. And so that's sort of like a Keynesian paradigm, and we're sort of stuck in that paradigm. Would you say that's like a fair way to summarize it, or how are you thinking of that idea, and how would an Austrian come back to that and say, well, no, actually, that's not right?
Yeah, I think Keynes, if he was alive, he'd be surprised. And I don't think you can really call it Keynesian. What we have now, the paradigm, it's a kind of neo-Keynesian mixture with monetarist ideas and, of course, a lot of modern monetary theory now coming in lately. So it's a kind of mixture, and I think it's a technocratic perspective, for which it's all quantitative aggregates of money flows, and someone being on the lever and just increasing money there and decreasing money there. And that, of course, misses the picture what all this thing is about, what all the economy is about, and that's fulfilling the preferences of people. And the more you intervene there, the less it fulfills this function, and the more it becomes a futile project of just employing people, paying them slips of money or digital kinds of money, which you then spend senselessly and so on. And that's not what was meant by market economy by the analysts of the Austrian school. I mean, Mises gave a very good definition. He thought that the market economy is where the consumer and the saver decide about the production structure. And it's like every cent they spend is a voting, is a vote that they give on the market. And I think we're seeing less and less of that. So I wouldn't call it a market economy even. It's a kind of a mixed economy where more and more of the productive structure is not determined by the preferences of the consumers, and particularly the savers, which of course is the other side of consuming. If you can't say no, then you're not really sovereign, and it's all about the sovereignty of the consumer and the saver. And that's what's really worrying me, that we you get a kind of reaction towards what's perceived as a market economy, perceived as capitalism, which in fact is less and less so.
It's very ironic, but people look at the system today and say, oh, look, it's late capitalism, when really what we have is a very strong amount of government influence and interference in the market for money. Now, I think an important point that might be good for you to explain for the listeners is just that point you were making around the structure of production, right? So it's not that goods are just magically created, right? There's a structure to that. And can you explain a little bit around that and the role that interest rates form in coordinating that structure?
Yes, most people think that capital is money, but it's only, of course, part of a structure. Capital is actually a structure. Böhm-Bawerk called it a roundabout production. So you take a roundabout way, and the structure means a combination of very different aspects, and a lot of them are mental aspects. It's ideas, it's experiences, your talent, which you have to match somehow. As in the puzzle piece, you match it with the material goods around you, the capital goods around you, the tools, potential tools, but there's nothing objective material about being a tool. A tool is something you perceive as a tool and you know how to use as a tool. And that forms a quite complicated structure where every person should try to be best fit as possible as in a puzzle and producing what people will prefer in the future. And you see there's an intertemporal aspect in that as well, and that's very important. It's you have to produce before you can consume. You have to have the structure around before it's even realized by the market that it's of any value. So it can be without value. It's nothing objective that you can see in the material goods. It's how those tools are used and how in the future people will decide the results of the use of these tools turns out to be. And this intertemporal coordination is very important because when waste happens, it means there's a lack of intertemporal coordination. And interest, the interest rate is a price for or the price that enhances this kind of intertemporal coordination in the capital structure. That's why any intervention with interest rates has a more pernicious effect than a price intervention, because usually price intervention is a price for some good, so it disturbs just one market. But if you have intervention in the interest rate, it disturbs the whole intertemporal adjustment of the capital structure. And the downside of that is potential capital consume. Which means it feels as if you're wealthier than you are in the long run. And then there'll be bills to pay in the long run. There'll be corrections in the long run, which are negative surprises to many people. And that's, of course, what the crisis is about. It's a whole lot. It's a cluster of negative surprises, a cluster of errors that's revealed. And an error always means that there's waste going on, that things that could have been used in a better way have been used up already. And that means poverty to some people. It means frustration to many people. It means a change of life plans in a negative way for many people. And that's really what you want to avoid. And that's why there needs to be an intertemporal coordination in the build-up of a capital structure.
Excellent. And so it's basically making that point that you might have a kind of false prosperity because you think you're really rich when in reality you are kind of chewing down your capital stock, or you are consuming your capital stock in ways that are just not efficient, right? Now, I've heard the great Bob Murphy make an example. It would be like saying, you're living in a hut, and instead of using like normal firewood for the fire, you like take your really nice wooden couch and you throw that in the fire, right? And we're kind of, it's like that would be a very inefficient way because we're not allowing the natural way of the market to drive the production and intertemporally order it in a way that is more efficient for us. We're actually taking these things and just like kind of wastefully throwing them. Maybe a modern day example might be something like a company like Uber, right? So there might be a lot of drivers who are not necessarily taking into account the depreciation and amortization costs of their car, but they think they're earning money out of it. And yes, they are earning money out of it, but maybe they're not accounting for all the correct costs. Yeah. Is that a good analogy, you would say?
Yeah, that's a very good example. Yeah, a lot of the capital consumption is actually increased profits taken out of companies. It's too high a salaries, not taking into account depreciations. and so on. So yeah, that's what capital consumption looks like. And then, of course, a lot of the transfers happening in political systems, a lot in the pension systems, huge problem with that in the European Union. So there's a lot of pre-consumed wealth, which somehow sets your mind, and then we are up for some really bad surprises in the future.
Right, yeah, and we'll get into some of that. I would also love to talk a little bit around the situation with government bonds, right? So as you point out in your book as well, I think you even make a point that there are some Argentinian, what's called Methuselah bonds, and they're like 100-year bond. And yet anybody who has any vague idea of history knows that Argentina has had many monetary problems over the decades. Why would anybody trust a 100-year bond?
Yeah, actually, the best performing asset I think in the last year was the 100-year Austrian bond, because Austria, of course, has a high credit rating because the Austrians are perceived to be very good payers of taxes, and that's basically what it's about. But in a sense, bonds have become a kind of base money. So it's like money, but it's not having the banking risk in it. You just have the state default risk. And once the state really controls monetary policy, and you got international organizations coordinating like IMF and so on, this risk is deemed to be much lower than any kind of banking risk and, of course, any kind of entrepreneurial risk. So when people tend to become wary of maybe underreported entrepreneurial risks, then they go for bonds as well. So we've seen this kind of bond bubble. But it's really just going for base money in a sense. It's like a default account now because in the last economic crisis, we've seen that central banks are taking making everything it takes to buy up bonds when the price is falling down. So it's perceived as a systemically relevant assets which will always be protected. So it looks like the safest asset, and at the same time it produces high yields if you see the appreciation of the bonds. So it's really been a star for investors, bonds. And I think is the last few ways to really make lots of money is to make the carry trades, is to get the zero interest money and then buy up bonds with higher interest rates. As in Argentina, for example, we get a few more percentage points. And if you have very long credit lines, you basically get free money out of that. And that's the reason why investors are so happy with those kind of bonds.
Right, and so it's essentially a big leverage play, and we might say that it's only in this fiat money world that you can achieve that kind of leverage, because it's only in this fiat money world that credit is that available. And if you contrast that with, say, a hard money world, there's not going to be that much credit available, and therefore they won't be able to play these leverage games, correct?
Sure. What kind of real saver would put his money at a test there and just get an upside of a few percentage points, maybe 2 percentage points, but take the whole downside of speculating in Argentinian bonds or who knows what, and leveraged speculation into those kind of things.
Right. And when we're talking about the overarching system of government bonds and funding the government, essentially there's probably two main ways you can lose out of that, right? So one way is that if a government were to repudiate its debt, and if you are a bondholder, then you lose out in that scenario. Or the other way, and probably the more common scenario, is that they do repay you, but they're repaying you back in fiat dollars that have gone down in value over time. So can you spell out a little bit of your thinking on that?
Yeah, of course. That's the way it works, and the likelier way. I mean, it's only weak states who default. It's states of which the debt is held mostly by powerful outsiders and not inside the country. If your citizens are holding your debt, then hey, basically you're free to do whatever you like. And to prevent political turmoil, usually it's better to go the hidden way, and that's just inflation, depreciation of the currency, and that's why states really like that kind of financing. And it seems effortless, and that's where modern monetary theory goes, basically saying, okay, we're already there. I mean, if you can produce as much bonds as you like, because you'll always have the central banks buying it up. If private investors are not buying it up, then basically it just means money production. And that's correct. I think a lot of the analysts analysis of the modern monetary theory turns out to be correct, it's not because their models are right, it's because the world has become like their models and as crazy as their models. So a lot of the analysis is correct, that if you only insiders hold the debt, you just produce as much as you need. And that's basically everything you need to know about money.
Right. And so the challenge is that most people don't understand that they're really just losing a lot of money against the inflation. So they might store some of their wealth in bonds, but then in reality, their real purchasing power is just going down over time.
Yeah, the big problem is that historically bonds and stocks were inversely correlated. So you could play safe, and you usually had a mix between bonds and stocks. So you combat depreciation by holding stocks, but you have some safety of the corrections by holding bonds. But that doesn't hold out anymore, because right now bonds and stocks are positively correlated for the first time in history, and that makes it really difficult for the average investors. And of course, you're losing money by leaving it on the bank account, but now it's not even sure you'll be protected from the next correction. If you go conservatively investing, just trying to keep up with the depreciation of the money, you may lose even more.
And
if all assets go along and correlate, and that's the big problem in investing right now. Basically, almost every asset is correlated, and that's why every asset has been appreciating. And people are looking for more and more exotic assets. And that's also where the Bitcoin story comes in as a one potentially not yet correlated asset. And every correction in Bitcoin, which is not correlated to a stock exchange correction, is a very good sign for the long-term Bitcoin investor, because it may show that it's inversely correlated. But we can't be sure about that, of course. That we'll only see in the next correction.
Right, I see. And how, in your mind, does that change the way people think about their cash balance, right? So right now, okay, when you're living in a hard money world, then your cash balance is more meaningful because you have more certainty over that, right? Like whether that's gold, or let's say in enough time people are holding Bitcoin and they consider that their cash balance. But nowadays, it's like you can't hold too much in your cash balance. They have to keep some in stocks and bonds and so on, because they feel like they're losing pace against inflation.
Yeah, even nowadays, a cash balance is defined as being in bonds. It's, of course, as a regular investor, an institutional investor, cash means being in monetary funds, and those are short-term government bonds, actually. And we've seen that those assets are protected, are even better protected than the bank accounts. It's like a limitless guarantee by central banks, and that's how almost every investor keeps cash nowadays. So the meaning of cash has totally changed.
Right. And I think you make a great point there as well. And this ties into the point around government debt, because this whole architecture and scenario that we're living in today, it helps fund government debt, because now we're holding something that helps the government basically palm off its costs onto the rest of society. Can you articulate a little bit there around why this bond system now and this fiat money world helps fund a lot of that government welfare and warfare states?
Yeah, every government bond is a claim on future tax payments. So if you hold a government bond, you're actually holding a claim against yourself, on your future self, and your kids, your grandkids, if you have the Methuselah bonds, and so on. So that's really challenging and morally challenging in a way. So more or less, the market seems like, which is not really a market. My teacher Roland Barthes called it the money socialism. This kind of money socialism forces you to hold claims against yourself as a cash balance, and that's really odd. And that, of course, is great for government financing. It has never been as easy as that. Even in times where there's no real economic growth, our governments are overflowing in tax revenue and decreased financing costs for the debts already. So they have lots of money on their hands. And of course, they are eager to take over more and more functions of the market economy and of a functioning society. And that's another really bad downside of this kind of zero interest rate policy. It leads towards a kind of statism, where the state is seen as the gap filler in every kind of way, not just output gaps, but every kind of social gaps of market dysfunctioning, apparently, which of course is money socialism dysfunctioning, and so on. and we should be really wary of that.
Yeah, and as we have seen over these last few decades, you make this point about interest rate asymmetry. And so you're saying that the rates are being lowered more sharply than they later have been raised in each cycle. So can you elaborate on that?
Yeah, this is like the interventional spiral that we've seen in politics. It's always easier to go one way than repeal the errors you've made before. And it's a bit similar with decreased interest rates. Decreased interest rates make more people and politicians dependent on easy money, and it's really hard to withdraw a drug from a dependent from an addict. So that's more or less the reason why it's more difficult to increase interest rates. If the market already anticipates lowering interest rates, then even a stagnation of interest rates is like a bearish sign. So you have to increase the dose higher and higher, the kind of easy money, to just keep the thing going. And it seems out of the question right now in Europe to increase interest rates because the tensions are not decreased in the political area, and everyone is afraid, of course, that the euro may fail, and that the Brexit was only the first big challenge. And with the UK going out of the European Union, we have a majority of the more southern, more spendthrift countries in Europe. And of course, it's not at all in the interest to have increasing interest rates because that would end the spending bonanza that's going on and have a Greece-like correction happening there as well. And of course, Italy is already threatening to leave the euro project to have their kind of even more depreciating currency they had before, to make it even easier to continue with an unsustainable system they've become used to.
Right. And I think also another point you make is that it's like a monetary hot potato, and each Fed chair is passing on to the next. So a central bank leader is passing it on to the next one and saying, okay, now it's your problem. You deal with it.
Yeah, definitely. But that's short-termism, and we see it in politics, and we now see it in monetary politics as well. And actually, the whole point of central banking is to combat the short-termism of people on the markets. So you should have a more long-term oriented monetary policy. But this kind of hot potato monetary policy, of course, is the definition of short-termism. We see we can increase interest rates, so we just keep on going and see where it goes and see how the next one will cope with it. And we've had a change already to Mrs. Lagarde in Europe, which was quite well observed shift. And Mrs. Lagarde is quite intelligent, bright person, but very pragmatic, technocratic personality, a French politician. And what every central banker is trying to do is to come up with more innovative ways to avoid going for nominal negative interest rates, and do whatever it takes to come up with ideas to produce liquidity without the markets realizing it, without people anticipating it, and somehow still keeping in control. So Ms. Lagarde is really interested in digital currencies, and I think she'll go for the kind of central bank digital currency way, which is like the hottest idea among central bankers right now, who think they somehow can copy the success of Bitcoin and make it their own, and use the hype surrounding it and the coolness and innovativeness surrounding it to somehow hide behind their very uninnovative, very uncreative kind of monetary policy.
Of course. And with this monetary policy, I think it's also, we have to talk about the social consequences. Now, listeners who have read Guido Hulsmann's The Ethics of Money Production, there's a chapter there about this. And I think your book, Rahim, actually expands on some of these ideas and puts them almost into more context for today of what are some of these social consequences that we are seeing. Because usually when you have like a low interest rate, what should that normally signify versus when we've got an artificial low interest rate? And can you expand a little bit on what some of those social consequences are for us in society?
Yeah, actually, a lot of credit goes to Guido Hulsmann, who's a very esteemed colleague and German-speaking as well of mine. And in his Ethics of Money Production, he pointed out the societal distortion by inflationary policy. Of course, we've gone from there and much deeper in our analysis, in not only looking more detail how these effects look like, but also we've seen difference. It's not just an inflation that's going on. It's kind of really interesting zero interest policy, monetary policy going on, which is unlike past inflations. So there it differs a bit in the detail. There are more kind of interesting paradoxical tensions happening within society than it would be with an outright inflation going on. And we've looked into that in more detail, and we could analyze a lot of the polarization happening right now in politics, but also in society. It's really correlated to the kind of monetary policy. In a zero interest rate on the market, question if that could ever arise. If we have a tendency towards a zero interest rate, it means that people would not distinguish between future and past. And it's only thinkable in a very theoretical way. It's people who have a very ascetic lifestyle, and they really forsake the present life and wouldn't care about retaining anything for themselves. So they'd be willing to give up all their savings, all the money for basically nothing, because they say it's better someone else have it. Better it's used elsewhere than for myself. So there's no kind of inclination for consumption. And of course, we see it's a totally different picture at the moment. It's increasingly consumerist society, but still the market gets the signals as if there'll be so much money available for investments because no one wants to consume, and as if there was money for an infinitely long-term investment periods available. So you get a very strange distortion of the productive structure, which shows a big mismatch with the actual preferences of the population, without people really realizing it. And that's a lot of tension happening there, and a lot of the capital consumption happening, for example, the increase in burnout rates among employees, the increase of seemingly bullshit jobs, as David Graeber calls them, and he doesn't really analyze it, so he just coined the term, and of course gives his kind of anti-capitalist reasoning for it. But it doesn't make sense. If a market economy is about matching the preferences of people, it wouldn't make sense that you have people going voluntarily for jobs that don't make sense. You can only explain that through this kind of distortion of the production structure. And of course, that debt has become a way of life for people, so they become really dependent on going on with paying the rates, which are, of course, are anticipated for the future as if the present would go on as it is, which means they keep their job, they keep the purchasing power, and the house retains its value, and so on and so on. And that kind of leads to a way of life which is really a dependent debt servant in a way, and makes people very reluctant to go out of the way to be critical. And you have a lot of this naysayers running along, and there you see even a change in mentality happening.
Right, yeah, and I think it's you really put it well there when you were saying it's almost like the quote-unquote signal is that we're all aesthetics and we don't need that much, and but then in reality, what is driving is the complete opposite, where it's complete consumerism. And in your book, you spell out some nice examples. It might be good to talk through some of those just to help make that a bit more real for people. And you point out here, there's this whole phenomenon now with travel and Instagram and airline miles, right? So it's airline miles are a huge thing. Everyone's got a credit card and they're all, talking about travel hacking and so on. And what's actually paying for all of those airline miles?
Yeah, that's actually banks buying the airline miles and credit cards, and they see it as a kind of a trigger spending. So by traveling, you try to copy that kind of consumer-heavy, consumerist lifestyle, and they'll hope, of course, you get a very cheap flight. But then you continue spending and trying to get the perfect Instagram photo from the infinity pool as everyone else gets it. So it's kind of avalanche of spending happening there. And it's, of course, credit card companies making money not only on the fees, but also on the overspend, overdraft, really high interest rates. I mean, the last remaining high interest rates are there by people consuming too much and not really anticipating that increased consumption and going overdraft on the credit cards, and so on. And of course, there's kind of short-termist consumerism, which I don't think consumption is bad per se. I don't think traveling is bad. It's just we try to understand why is it happening to such a large amount? Why is it becoming so ubiquitous? Why is it so obvious? Why is more and more of advertisements going for that kind of consumer spending? And that, of course, you can only explain by explaining where the money comes from, because in the long run, a fool and his money is parted always. So you spend more than you take, you'll be just shut out of the market as a consumer. You don't have any more cents, any more votes to spend on the production structure. But of course, there seems to be an infinity of new votes being added to this kind of voting process. And that explains why more and more entrepreneurs try to go for this scale up consumerist markets, and where there are a lot of paradoxical business models where you don't have the actual consumers spending the money, but he pays with attention spans and so on. And you try to go all this backward, hidden way, roundabout way of getting most money out of the consumer scheme that's happening. And traveling is one of the fields where that's happening.
Right. And I think you make a good point as well that a lot of the actual revenue for airlines now comes from those frequent flyer programs, because everyone's trying to chase those points. And then it's like the revenue is coming from like the credit card companies almost. And now another point I wanted to touch on, you mentioned this as well, around the business model, right? Because in the normal capitalist world, the entrepreneur is trying to serve the consumer. But in one point you make in your book is that actually now entrepreneurs are sort of serving lenders and egos. Many of them have this desire to leverage the reputation of being a serial entrepreneur, and they try to get bought out by some really even bigger company, and they're sort of surviving off of that.
Yeah, that's one of the main problems, that it's not really a market economy when you don't have the link between serving a consumer, the real consumer, and serving him long term. If you want to have a long term business, a sustainable business, by going through leveraging as much as possible, being fast, being first, and of course, by leveraging, you have all these kind of potential laws being even more extremely enforced. It's being number one really pays out if you scale on the global scale. And then, of course, entrepreneurship changes in a way. It's what an entrepreneur is like, what is perceived like, what are the most popular entrepreneurs who are deemed to be successful. Of course, a lot is also the attention by the media. It's very short-termist. You don't look at track record. You don't look into if someone has really been in the business for long-term, serving customers. It may be a success story that's a 1 year old, and the next year it may be known as a fraud to everyone, and build just as big a story. So we have this kind of Theranos-like scams increasing, where you try to leverage your personality as a startup entrepreneur, and you try to take out as much as possible of that. It means access to venture capital, access to legitimacy, attention, and so on. I don't think it's bad per se to have an entrepreneur who's focused on the more short time span, attention span consumer. I think that provides value to a lot of people, of course. But it's bad if you have this kind of density, and all the whole focus of being an entrepreneur shifts to that field, because then I'm afraid of the long-term consequences and the perception of people. And maybe you have more and more young people saying, "Oh, I don't want to be an entrepreneur. It's like being a scammer or something. I want to do something serious." And maybe that's one of the reasons why a lot of millennials say they'd really like to work for the states. For government jobs. They're looking for government jobs, not only because they seem to provide a long-term stability and safety, but also because they seem to be more moral, seem to make more sense, and so on. And I think that's a really worrying sign we're seeing here. It's not those young people being statists per se. It's they react towards a distorted market economy, distorted jobs that they find on the market. React this way.
Yeah, and as you say, it's like subsidizing of the present by the future, and it's like these capital consumption entrepreneurs are just arbitrating from the future to the present.
Yes, definitely. I mean, they're just doing what they're supposed to do. It has all the signals that are sent to them. And in a sense, I wouldn't blame the entrepreneurs. There's still entrepreneurs creating lots of value. And of course, having this kind of value in entertainment is amazing as an expression form for artists. And the best artists of our time, of course, right now are in this kind of short-term entertainment, producing amazing series for TV or streaming, and so on. So there's a lot of value created for people. It's just I don't think it should be in a larger proportion. I would like to see more of creativity going to fields that really bring forth humanity in the long term, and so on. And this kind of arbitrage is really distorted, caused by distorted signals on the pseudo market, and first of all by distorted interest rates.
Right. And actually, you talk about another idea that we might be seeing an increase in political correctness as well, and that there's more conformism as a result of separating the short-term benefit from long-term consequences and social costs. Can you elaborate a little bit? What are you getting at there?
Yeah, more and more people are kind of living in bubbles because the whole life happens in bubbles. Then educational institutions, which in a way are separated from the real world and are as well beneficiaries of this kind of monetary policy. There's been a boom in educational institutions, also private education, but of course certified by the states. There's a kind of fake market happening there. And then going on from your educational institution until in your mid 20s already to a job in a big corporation or something like that, where you're insulated from really serving consumers as well, because those are not sustainable structures. They are bubble structures, so you remain in the bubble for a very long time. And remaining in the bubble, being insulated from real consequences for real people, of course, fosters this kind of mindset, which just focus on your kind of level and the place you're working at, and you realize this kind of egoistical institutional interest where you're in. And of course, that helps along. And then you have the conformist pressure, of course, that I mentioned before, by probably being in debt already, by starting out a life in the United States, even starting being in debt by spending time in the educational institutions. In Europe, it's more government debt that assumes debt, so it'd be your future tax spending that has to cover it anyway. So it's not that different, the situation. It's a bit more obvious in the United States, but then less obvious at the same time, because this kind of credit financing is subsidized by a large degree and unseen, ununderstood degree by most people. So it's similar systems where in different fields you see these misalignments and mismatches. So being separated from reality and being a conformist leads to this kind of thinking that pervades even universities right now, where you have mostly it's the we call it the middle powder, the middle sector at the university, administrative staff really running things, and they're small mind bureaucrats basically going along, indebted bureaucrats who spend time in the same educational institutions, never been out in the real world, and just cling onto the jobs and cling onto every kind of power they can get. And so I don't think it's about ideology if you have this political correctness at campus right now. It's about conformists trying to cling onto power, having something to control other people with, and trying to assume a kind of administrative responsibility, to construct a kind of safe haven around people, and just perpetuate a kind of bubble they're in, and get more and more people and money spent in those bubbles.
Yeah. And I think we've got to talk about the devastating impact on savers. Now, you have a great example in your book where you talk about this baker analogy, right? And so this idea is, okay, imagine we had a price control of 0 for bread. Well, it's not that bread would be free, it's that less people would become bakers, right? So it's that, like, why would you be a baker if you're not going to get anything for it?
Yeah.
And now you say, well, in this analogy, what about savers? Because if you give people basically 0 return or negative return for saving, what does that do to saving? It just annihilates them. The harvest is not enough of the amount that they've saved. They have to now consume their seed. Can you articulate some of your thoughts on that?
Yeah, that's a prediction by Keynes that actually turned out to be correct, but what wasn't correct was what he thought would go along with it. It's the euthanasia of the saver. That's what he called it, because he thought that the saver, in the sense of the hoarder, is really an unproductive part of the economy. It's basically old people holding on to the money, not investing it, and that's a very wrong point, very wrong interpretation of the economy, because you have to hold liquidity to have this intertemporal coordination between future and the present going on. So you need always people providing liquidity to the markets and holding on to liquidity on the markets without any negative impact for people. And in order to make investments, in particular long-term entrepreneurial investments, you need to have liquidity available. Because you can't do these investments in small pieces. You can hoard in small pieces. That's why hoarding is that important to the small saver. And that basically was the way to go on saving in the past. And this kind of saving has disappeared, or there's a lot of pressure to disappear, because it doesn't make sense anymore, of course. There are still old people trying to save their way, but they lose all of their purchases.
So I guess in terms of where we're at and where we're going, what are some of the potential ways out of this zero interest rate trap?
Well, the likeliest way is really the modern monetary policy way, and that's just really go without any kind of remaining independence of the central banks. Is just make the treasury produce all the money they need, and then just have the state fill all the gaps. So with private employment disappearing in that kind of economy, and I think it'll be triggered by losing trust in money. Of course, you have a decrease in investment, decrease in division of labor, and you basically go into full-blown kind of socialism. It's not direct socialism. It's a new kind of socialism. But I'm not that pessimistic, because I think we have. So that's the way where it goes policy-wise. But that's not, I think, necessarily the way it goes on a global level, because every step you take in this direction increases the signaling power of the distortions on the market. So people react to it, to go towards other assets. So immediately, if you pursue that kind of policy, you need to have strict capital controls. You have to control every kind of spending and assets. And that, of course, becomes obvious for people. And you have new assets coping with that, new entrepreneurs coping with that. I think one of the main reasons Bitcoin has appreciated that fast as no asset in the past, is really the best performing asset in history so far, was due to Chinese capital controls, because the Chinese, of course, have been all going on with the same kind of monetary policy, but they have that Communist Party in power, which deems to be more able to control people. So they have really tight capital controls, and Bitcoin has been one way which really, in the proven way, has allowed people to kind of escape these kind of capital controls and shift the savings out of the Chinese system. And I think we'll see an increased value of those kind of assets and those kind of solutions. And that, of course, makes it futile a kind of monetary policy. It's happening. It may even mean that people go out of government money, fiat money, and start counting in new assets and so on, try to keep their savings out of the system, and even try to keep part of their investment out of the system and so on. So that increases the pressure. And I don't think heterogeneous political area like Europe can really keep up with that kind of pressure, because you're always too slow if you have to coordinate between different nations, different nation states. So, of course, I think if they pursue the kind of monetary policy further, it will. They think that they are easing up the pressure and the conflict potential, but actually they're increasing it on the long term. So we'd rather have a destruction of the euro and the whole European process than continuing this kind of monetary policy. So I think it will become obvious the failure of this kind of monetary policy, and I think the jurisdictions that can hold out, that realize the potential and really offering a money that you can save in, will be the winners of this kind of shift that's happening right now. And of course, within Europe, right next door to Germany, we have Switzerland, we have Liechtenstein, with their own currency, and their central bank, of course, tries to keep up with the inflation rate of the euro. because people are used to somehow have stable money, and they just look at the fiat monies they compare it with. But it's already crazy what the Swiss National Bank has to do in order to keep up with this depreciation of the other currencies. So they're one of the biggest investors in Facebook right now, for example, because they just keep up buying dollar assets and they keep up buying euro assets. And of course, they buy up the best performing assets because they are not stupid in a way, but it becomes more and more absurd that you have a central bank then buying all those kind of assets to just keep up with the depreciation of the other currencies. So there might be a stopping point. They might go for two different Swiss francs, one Swiss francs that may stop depreciating, and so on. And we see it's a really interesting times to be alive. I think we see a lot of entrepreneurial solutions. I think we see a lot of jurisdictions stepping out of line with other jurisdictions. So I'm really optimistic in the long run that this kind of distortion may have a natural end.
Right. And I guess just to summarize the way I'm thinking of what you're saying, it's like as these central banks continually accumulate more and more of well-known large public companies, it's almost like a nationalization of some of these big companies. And as someone like, say, Hans-Hermann Hoppe would point out that, it's just increasing the politicization of society, because now you can't just run a business, you have to run the business, and that business is also very highly influenced by the government. And so it's kind of like a backdoor nationalization or backdoor creeping statism over time. And so we really are faced with that choice of, do you want to save in the government money and be a part of that whole government system? Or are you going to start saving some assets outside of that system, whether that's gold or Bitcoin or some of these other ways of kind of doing that? Yeah. So look, I think we're coming to the end of time, but Rahim, make sure you tell my listeners where can they find you. And I think for my listeners, I do want to definitely recommend reading the book. I think there's a lot of great insight in terms of social consequences of fiat money, as we've discussed today. So Rahim, make sure you let them know where they can find the book and find you.
Thanks a lot. It's the Zero Interest Trap, it's called. You can find it on Amazon and I hope in bookstores around. It's only a few of my books have been translated to English. Another one was the Austrian School for Investors. You may want to check that out as well. Apart from that, I'm mainly speaking and writing and lecturing in German. But you can find some YouTube videos in English as well. A few of the lectures I do in English.
Fantastic. Well, thank you very much for joining me. I've really enjoyed chatting with you.
Thanks a lot. Bye-bye.
So I hope you enjoyed that. I'm currently in Austin, Texas, so look out for an interview next week with Will Cole from Unchained Capital. Also, next week, we've got Advancing Bitcoin, the developer conference that's on in London, 6th and 7th of February. So if you haven't already got your ticket, go to advancingbitcoin.com and use the code LIVERA. There are still some last-minute tickets available. And for those of you just around, make sure you ping me on Twitter or give me an email, and we might be able to do a meetup for listeners of the podcast who are interested. As always, check out the website, get the transcript and the show notes at stefanlivera.com. Thanks for listening, and I will see you in the Citadels.